Hi, I'm Matthew Coupe. I'm here at TradeTech 2014 and I'm from NICE Actimize. The point of view of increased regulation and the increase of asset class coverage, this is obviously something of mass debate and is increasingly finding challenging how we can respond and what we can do to it. Certain areas, fixed income and OTC swaps and FX, have clearly been in the press quite a lot with the coverage. So from a swaps perspective, Dodd-Frank is a key piece of regulation which is sweeping globally, not just from the US, and has an impact from that area, and covers a large range of areas, whether it be communication surveillance, transactional surveillance or reporting and transparency. So when we look at FX, this has obviously been a key headline-grabbing piece of global media coverage when we're talking about benchmark manipulation and rigging, and is a key area where I think we're just touching the tip of the iceberg in fines and sanctions that could actually come down. Now, regulation in FX is relatively limited at present, but this is going to increase massively. And again, with a large number of OTC transactions coming through, how you can survey and how you can keep check and reduce your risk is a key area to understand. Fixed income is another massive area of debate and is a key area where focus, where the new regulation, specifically when you're looking at MiFID II, is trying to bring greater transparency to the market from a post-trade and also a pre-trade perspective, and it's going to have a massive far-reaching effect. NICE Actimize is tackling this in a number of ways, but the best way to sum it up is through a holistic approach. When we're looking at transaction surveillance or trading surveillance, you need to be able to piece together the full story. And this is where NICE Actimize comes together. Traditionally, Actimize has been considered the one part of the entity which actually does the transactional surveillance of what's happening. However, there's another massive key piece to this puzzle, and that's around the communication surveillance as well. And being able to understand the voice conversations, the Bloomberg chats, the email chatter, and being able to put together all the communication that happened pre-trade, and then overlay that to make sure that the transaction itself wasn't manipulative, nor was there any intent prior to that to prove manipulation. The loopholes that might arise are on the markets which are less transparent and more exotic, where the regulators might have less comprehension. A classic example of this could be the quote-driven market, say for fixed income or FX, and where they may not be able to prescribe the transparency, or the transparency might not be prescribed to then enable to have this pre-trade transparency.